well, let's settle on this for a bit with Mr. Bismarck Rewane, the Chief Executive Officer of Financial Derivatives Company. Mr. Rewane, good morning and welcome to the program.
Good morning, and thank you for having me.
So yesterday we talked. I mean, it's been going on, and we had highlights of the pros and the cons of this war between Israel and Iran and what it's doing to oil prices and what it could do to Nigeria. So we've seen that it could increase government revenue, it could increase the prospect of investment in the oil and gas sector. But of course, we know it also has consequences at the disruption, the uncertainty, and a possible hike in the price or at the pump. That's also, but from your perspective, where does Nigeria stand? Do the pros overcome the cons, or is it the other way?
I think, first of all, Nigeria is a non-aligned nation. Therefore, Nigeria will be neutral in things like this. Secondly, Nigeria is a very small part of the global economy. In other words, our GDP is less than 0.25% of global GDP. Therefore, it is clear that Nigeria will have to pursue its own strategic and vital interest. What do I mean by this? I mean that we would increase our oil production to the maximum. Right now, we are at about 1.45 million barrels. We would increase our investment in the oil sector. We'll also look for resilience to make sure that our infrastructure is strong enough, and therefore we begin to increase our GDP and our own income per capita. So Nigeria is not going to solve global problems. Nigeria is going to solve its own problems. And I think that is a critical issue now that we have to deal with at this point in time.
So how does this affect, for instance, apart from the revenue, crude, being a member of OPEC, and the domestic refinery industry or sector?
Well, let me put it clearly. I think first and foremost, we used to produce about 2.4, 2.5 million barrels a day. We are now down to 1.4. We are fringe players as far as OPEC is concerned. We are price followers rather than price leaders in the cartel. The biggest producers here, the guys who control, who lead prices are Saudi Arabia, to a large extent Russia, and the United States. So I won't bother myself too much, but let us go back to deal with two critical things that have happened as far as Nigeria is concerned. One is that inflation data has come out, which shows, as we projected last time I met with you on this program, that inflation will decelerate, and we've seen that slight deceleration. One. Two, that the Dangote Refinery has intervened to bring about uniform pricing in for petroleum products across the country, which is a major development. So we have to look at it in the context of, one, what happened to price inflation. If you look at price inflation, you'll find that the highest level of food inflation in the country is in Borno State, as high as 38.93%, while the lowest rate of inflation is in Kwara State. In fact, in Katsina State, Borno State has 38.93, which is in the northeast, and Katsina State 6.90. Why is there such a big difference between food inflation in the northeast and northwest? Because of two things. One, insecurity. Two, because of price of petroleum products. That is where the Dangote initiative of bringing in CNGs and offering credit to the to the retailers is a major game changer and will actually alter, one, will reduce inflation, two, increase output, and three, allow the proceeds and the dividends of economic policy and reform get to the ordinary man.
So, but Mr. Rani, talking about that, I wonder if you've heard Petron. They have some concerns about Dangote's intervention in the value chain. They say Dangote is big and should be rubbing shoulders with the international refiners and not in the value chain in the domestic sector of it. This could cause jobs, they say, and this could also give Dangote too much edge and be building towards monopoly.
No, I disagree with you. First and foremost, there are 11,168 petrol stations in Nigeria. Independent marketers have 2,100, and major marketers have the balance, right? Now, what Dangote is doing is two things. One, getting your product to you anywhere in the country at the same price, uniform pricing, eliminating the bridging cost, and also reducing the cost of logistics. Is using CNG trucks, 4,000 and all, to get products across to all nooks and corners of the country. So the middleman does not, first of all, does not invest. The middleman in economics is called a parasite of society, and therefore they extract margins for distribution. Now, what the Dangote Refinery is doing is bridging this distribution, putting enough products, offering credit for that matter, right, to the retail segment of this business. In fact, it's doing about five. If my memory serves me right, they're doing about 5 million liters, and that's what is 500,000 liters to the public, and giving them credit so that they pay when they get delivery, and so one, it gives them products, two, it guarantees price, and three, is giving them credit. When you take these three to put together, it's a value add for the Nigerian public. And I've just told you now that inflation as high as 38% in one state and as low as almost 5%, almost 6.9% in Katsina State. The bridge that is going to deal with this is one, is dealing with security, and two, getting uniform pricing across every part of this country. That way you will see that inflation begins to decline, everybody benefits, the currency gets stronger, and the economy seems to be humming around. And investors will now come in, which will create jobs for people. So contrary to the view that it's going to lead to a monopoly, it is not. It is actually bringing about fierce competition and efficiency in the sector.
Yes, and then the other side of the question is sometimes it does seem like Dangote is being too generous. This is a business that has to do business and make profit. So is this not eating into their profit margin? Why are they so generous?
No, not necessarily. What you are doing, they are becoming much more cost efficient. So what people normally do, when you create cost efficiency, you pass on part of it to the public in terms of lower pricing, and you retain part of it as your own investments to increase your market share. So that's what's happening. Don't forget, Dangote is competing against importers, competing against modular refineries, competing against the market in all. But I don't know anybody who would invest $23 billion and not expect to make a decent return on investment. And to do that, is what it's doing is deepening the market and increasing the structure, the channels for distribution across the country. So you can actually distribute products by marine evacuation, by trucks using the CNG, and eventually you would have rail, and then of course the pipelines across the country. So these are just the early days, but we were not talking about this 2 years ago. 2 years ago, we were talking about queues and scarcity and volatility in price. Now we are talking about a consistent reduction in price. We are talking about availability across the country. We are talking about uniform pricing, and we are talking about increased productivity and moderation of inflation. These are major things. So our memory is short. That is why I think that people have to think deeply about and look forward. What is the retail segment and the downstream sector going to be looking like by January 2026? I can tell you categorically that there will be no queues. I can tell you categorically that pricing will be uniform across the country. And I can tell you categorically that smuggling of products across the borders will be reduced. So is that good for the country? Yes. Is it good for the economy? Yes. Is it good for investors? Yes. Is it great for the Dangote group? Obviously, that's why they invested. That's why they took the risk. And I want you to understand, if it went the other way, if it was losing money, if importers were bringing products in at a lower price, it would be out of business. And that is what happened to the NNPC refineries. They couldn't compete, they were inefficient, and more than anything else, they were government owned. Now we have private sector intervention. We should look at it from that context, that private sector investment, they could lose, but they could win, or they could make some profit. And if they make a profit, they can share part of the proceeds with the public and also themselves. And finally, you know that there's a consumer protection agency who are looking very closely to see whether one, there's collusion, to whether there's price fixing, and whether there's price gouging. That is what has happened, and that is what's happening today.
All right. I mean, that's oil production decline that we saw. I wonder if we should be worried at the time. I mean, this is half of the year. We know the target for this year is 2 million barrels. And for us to be dropping instead of progressing forward, I mean, or is this temporal? Can we expect that by the next numbers that we see, we'll see an increase?
I think it's temporary. See, the world, in the world in which we are living today, you know what's happening between Iran and Israel. We know what's happening in Iraq. We know what's happening in Ukraine. So you take every day as it comes, and quite frankly, if we can do 1.4 million barrels, that's good. But don't forget, NNPC announced a few days ago that there will be 4 FIDs, in fact, final investment decisions between now and the end of the year. Those are major developments. Secondly, we've had the divestment of the oil majors from the land and swamp and investment in the deep water. So all said and done, we think that the new board on NNPC will probably stay focused, but there's a lot of work to be done, and we need to ensure that we endear ourselves to the major oil companies so that they can invest. What is happening to Nigeria today is where there has been no new investment in this sector for a long time. This sector, to all intents and purposes, has been in a recession for about almost 10 quarters, but now finally is beginning to recover, both at the upstream, that's the exploration and production area. We are having it on the midstream, which is the refining, and then we are now having it at the downstream, which is the retail and outlets across the country. So we want to reduce our dependence on oil, but we also want to milk and take as much of it so that we can use that to drive other sectors of the economy.
All right, what's going on with domestic food prices, especially with this decline in inflation?
Yeah, now the truth is that in May, we saw a reduction and moderation. But the bad news is that in June, we are going to be seeing a change in direction. One, because of the Mokwa effect, the flood. Two, because the price of diesel has increased. Again, it's above 1,000. Both the imported price and the domestic price are going to go up. So we are going to be seeing this, and then the planting season effect. But fortunately, we are beginning to see in the month of June an appreciation in the exchange rate, both at the parallel market and the official market. So we now have 1,600 basically as the parallel price, the parallel exchange rate, and we're having 1,545 or something. So the margin between the parallel and the is now down to 40 naira, which is good. But at the same time, please remember that the dollar itself has fallen. It's now at almost a 3-year low against the basket of currencies. So what do we see? We see the price of rice staying flat at 82,000. That's what it is as of yesterday. Tomatoes come back up to 90,000. That's up by 12%. We've seen pepper stay flat at 185,000. And we've seen palm oil up by 7.69% to 130,000. Sorry, palm oil is up to 12,000 naira, while onions is up to 130,000 naira. So generally speaking, for the month of June, we would have higher, I think, a slight increase in inflation. If that is the case, and if we had April and May inflation declining and the month of June inflation increasing, we think that the central bank will have no choice but to maintain status quo again and not actually bring it. While many of us were hoping that they may bring down interest rates, caution will suggest that they will maintain status quo. If, and that is if, big if inflation actually increases, we think it will increase because of planting season, because of an increase in the price of diesel, and because of money supply growth, which has happened. So in balance, we do not know. But again, what you see is what you get, and what you don't see is what gets you.
Mr. Rewane, we hope what we don't see doesn't get us. Thank you so much for your time on the program.
Thank you for having me.